having your tenants pay off your mortgage for you. Well, it's one of the best parts about being a landlord, and one of the reasons why investing in real estate is such a popular way to increase your net worth over time. In our video today, we're going to talk about mortgage paydown and how much interest versus principal you'll pay over the first 5 years of your investment property's life cycle. We're going to look at variables like interest rate, amortization length, and loan to value, and how as a real estate investor, you need to strike the right balance of all of these factors in order to optimize the investment returns on your next deal. We're also going to dive into a real-world Calgary case study where we'll look closely at how the decisions you make about setting up your financing can impact the returns on a real-world example. Are you excited to dive into the exciting world of real estate investment finance? Okay, well, let's take a look. All right, well, what I'm going to do here is dive into a screen share that I've done where I'm going to actually skin a deal. I think this will be easier to show you than to explain to you when it comes to how to structure an investment property loan. So let's go ahead and dive into the spreadsheet straight away and crunch the numbers on an investment property so I can show you how to go about setting up the financing on your next deal. Okay, well, here we are looking at my trusty investment property analyzer spreadsheet. So I've been in the field of investment real estate for quite a while, and this is what I use to skin pretty well any deal that I'm looking at. So it's a fairly straightforward Excel sheet here, but it really helps to break down all the different things that you have to consider when looking at a real estate investment. So what we're going to focus on here today is this section of the spreadsheet, which contemplates the debt service. And so this is where you would input all of the details that relate to your investment property loan. So what we're going to explore today would be how the return numbers, which are over here on the right-hand side, both of ultimate 5-year return and the annualized rate of return, how those are affected based on decisions that an investor would make on financing a particular piece of real estate. So we're going to dive into this here in a second, but before we do that, I should probably show you what piece of real estate we are actually evaluating here today. And it's this guy right here. So this is just a pretty straightforward bungalow in a community called Cedar Brae here in Calgary that a client of ours purchased in the spring of 2020. And the intent with this buy was to purchase a property with an illegal basement suite and then fix up the upper level, so do stuff like change out the carpets and the lino here, but then also legalize the illegal basement suite that is in the basement. So here you can see there's a washer dryer combo unit in the kitchen in the upper level, so something needed to be done with this too. And these are some of the things that our investor was looking at to actively add value to the property, which we'll discuss in a different video. But the main objective of this property was to achieve positive cash flow. It did have to have a renovation in it. And so what we're going to do today is look at the mortgage financing implications for the investment returns on this particular deal. And here's a look at the basement suite downstairs. So the field of investment property isn't exactly glamorous. Here's a look at the basement kitchen that needed to be fixed up and cleaned up. But these properties are purchased with the intent to make the owners money. And so that is the underlying reason why we're shopping for them. And so we don't care quite so much about the looks as much as we care about the financial returns on these deals. So that's what the property looks like. In terms of where it is, here you can see it in Cedar Brae. So this particular investor bought in this location not only for its present day cash flow numbers, but because the Sutina Trail here has just come in Calgary, and there's this enormous Taza development happening here on the Sutina First Nations land, $4.5 billion, one of the largest developments by any First Nations group in North America, and this property is positioned to take advantage of it. So that's what it looks like. This is the actual piece of real estate that we're looking at. So when we dive into the numbers behind the scenes, you know what it is we're talking about. So high level, this place was purchased for $375,000. We had an estimated budget of $25,000 to fix up the property and legalize the basement suite for a total project cost of just over $400,000 when you factor in legal fees and appraisal and all of that, which means that this investor would need just about $100,000 to buy it at 20% down. Now, The reason why I'm breaking this down for you before we jump into the debt service numbers is we are looking at buying this property at $375,000 and mortgaging at 80% loan to value for this particular amount, and then using their down payment capital and then the renovation capital as actual cash coming into the deal over and above that. So it is possible within investment property finance to build in the renovations into the mortgage. It's called a purchase plus improvements mortgage. We're not looking at that here today though. This example is based at 80% loan to value on the original acquisition price, and then the renovations being paid for in cash over and above that. So that will play into the annualized rate of return, because we have more cash coming into the deal, because not only do we need the down payment, which is here, but we also need the actual renovation capital that's up here too. So for this deal, we are at 80% loan to value of the original purchase price, which means you have a loan amount here of $300,000. Our base case for numbers on this one, we're using an interest rate of 2.35%. And an amortization period of 25 years. So the amortization period is the number of years that it would take for you to pay off the loan if you just continued making payments at the prescribed interest rate at the first 5-year term. So it's being paid off over a 25-year period, which means we've got a monthly mortgage amount here of just over $1,300 per month. Now, we're not going to dive into all of the particulars that make up the cash flow element to this deal, but we will jump down here and show you that based on the numbers as they sit here right now with this financing structure, we do have a modest positive cash flow with this deal at $232 per month, with a cash flow and cash return of 2.8% and an estimated cap rate of 4.6%. So you can see here, not too bad in terms of cash flow numbers. This will make an investor some money. Our 5-year return, you're investing $101,000 to get a profit on paper at least of $98,000, almost $99,000 here over a 5-year period, with an annualized rate of return of approximately 15%. So what we want to explore here today would be if an investor, say, put more money down on a deal, or if the interest rate changed, or if the amortization period changed, and what all of those changes will do to affect not only the overall rate of return, but the cash flow per month as well, because that is often what real estate investors are getting into this for, is to get that better net income each month. So looking at this, if we came here and said, all right, rather than just putting 20% down for this deal, we were going to put, say, 30% down for this deal, what does that do? So now we have a much smaller loan amount here, by the tune of nearly $40,000 less, because we're now at 70% loan to value. So our payments have come down a decent amount. So as you can see here, we're up near $400 a month in positive cash flow, but our 5-year annualized return has dropped from about 15% to 12%, simply because we have more capital into the deal that needs to go a little bit farther in order to meet those same returns. So that's what happens there. So actually what I should do before I do that is explain how much mortgage is actually paid down over the term. So for our base case, we're back at our base case, 20% down here right now. You can see over a 5-year period, we've paid off approximately $46,000 in mortgage principal. Now, if you come over here to 30% down on that, the mortgage pay down amount is about the same amount because it's amortized over that same length of time on this. So you've got a similar amount of mortgage pay down on it, just a minor change on it over those first 5 years. But the cash flow is significantly better with more capital down, because you have a smaller loan amount and so smaller mortgage payments to pay it off over that 25-year period. So that's what happens if you put more down. If you were to, say, go to 5% down on this deal, whoops, we don't want to do it that way. We want to go up here instead and put 5% down. So let's say you were buying this property to move into it, which oftentimes investors will do. Well, in that instance, or first-time investors will do if you're just getting started in this business. Let's say you want to live upstairs and rent out the basement. We're looking at this strictly from the merits of an investment property perspective, so not factoring in your consumption real estate. You would incur a mortgage insurance premium here, so this gets tacked on to the mortgage balance. Anytime you want to do less than 20% down, in a residential property, you are going to have to pay mortgage insurance, which is a CMHC fee. That gets tacked on to your base loan amount here. So if we're at 5% down, you can see here, we're actually a negative cash flow per month deal because we have a much larger mortgage, $370,000 to pay off rather than $380,000 like we were at if we were 20% down. But if you were living in this property, then it's not so bad, because basically if you think about it, if you were paying a full equivalent rent of $1,550 to live in the upper unit, it's just going to cost you an extra $70 to $8 more, and you own this property rather than rent it. So something to consider there. If you're a tenant spending $1,500 or $1,200 a month, and you can scrape together the down payment plus renovation capital for a deal like this, you can own a property for the same monthly payment plus about $78 a month. And that's when you have property management factored in. You take property management out of the deal and you're actually to the good here. So it costs you less than the equivalent rental amount for an upper unit here to own this particular place. So that's interesting to note there. I like to keep property management factored into deals just in case you want to hand it over to a professional property manager one day. At least you know that it works within your budget. Okay, so what's interesting to note here though is that at 5% down on a deal, if you were coming into it, your annualized rate of return is much, much higher because you have less cash coming into the deal, which means that any dollar returns that you're getting over a 5-year period is a much greater return on the capital invested. And so your annualized rate of returns come up quite significantly. So just goes to show that if you can scrape together the down payment capital, investing in real estate, even with just a simple 0.5% growth rate, and even if you're negative cash flow just a little bit, your annualized rate of return is just so good because of all of this mortgage pay down that you were paying off over that period of time. So great to see that there. Lots of mortgage being paid down in this particular deal at 5%. Because we have to amortize it over that same 25-year period. So we've got a bigger loan that we have to pay off over that amount of time. So our mortgage payments are bigger and more principal is being paid off because we have $370,000 to pay off over 25 years rather than $300,000. So that's why more mortgage is being paid down over that same term. So those are the numbers at 5% down, but let's come back to 20% down now and move on to looking at the effects of an interest rate change and what that would mean for a deal. So we're here at 2.35% interest on this. Now you can get all kinds of different interest rates out there. If we were to say boost this all the way up to a 4% interest rate on this, you can see the difference here. So your annualized rate of return does come down a little bit. Your 5-year rate of return comes down a little bit in here. If you come down here, you'll also see your cash flow now changes quite significantly. So interest rate does have a high degree of impact on your overall cash flow position, because if you've got a higher interest rate, it means you're going to have higher mortgage payments, which means that even though you're paying off the principal, it's going to mean that you're paying more interest earlier in the year, in the first few years of it, which is why your mortgage pay down drops within this because of the amortization length and the way that when you make your mortgage payments, a portion of it goes to the bank in terms of interest payments, and a portion of it goes to pay off the principal. And the higher the interest rate, the more is being paid to the bank, and that over the first few years of the loan, early in the amortization, it will be a higher amount of interest that's going to the bank than is being spent towards principal. So that's why our mortgage pay down comes down a little bit here. If we go back to our base case, you can see it jumps back up to 46% and where we were with that. Now, what if we got a better interest rate? If we come down to 2% here, what does that do? Well, you can see you pay off a little bit more mortgage pay down, and our cash flow creeps up just a little bit. So these small changes in interest rate, like if we go up by 2.1%, it doesn't make a huge difference. You're talking just a few dollars a month in cash flow and just a very minor increase in your rate of return. So oftentimes investors will get tripped up just trying to find the best rate every time, but that's not necessarily as big of a deal as it would be, 1.1 or 0.2%, depending on the other things that are needed in terms of qualification. So making sure you're not being overly sensitive on rate is something that I would caution many investors to do. Yes, it matters, but it is not the end all be all. Okay, so that is mortgage interest rate. Now, what if we looked at amortization length? So if you're looking here at 25 years on this does make a big difference in terms of our cash flow projections. So you can see here, 25-year amortization, we have mortgage payments of $232 per month, cash flow of $232 per month, mortgage payments of $1322 per month. Now, if we were to change this to a 30-year amortization, which is available from many banks for even with investment property, you can see here our mortgage paydown amount is going to be less over this first 5 years, simply because we are stretching the length of time that we're using to pay this mortgage off from 25 years to 30 years. So less principal is going to be paid down over that first 5-year interval. But that also means then that our mortgage payments come down quite a bit. But if our rental amounts are staying the same and our operating expenses are staying the same in this, then it means our net cash flow comes up. So you can see here, by going from a 25-year to a 30-year amortization, here's the numbers at 25 years, we're $232 per month. If we go to 30 years for amortization, now we have some much more attractive positive cash flow and a much better cash flow on cash return of 4.7% on this deal. And our estimated 5-year returns creeps up just a little bit. Our annualized return does not come down very much. So this is something that I would recommend you do as a real estate investor. The most risky years for these deals are usually in the first few years. So if you can get that cash flow out of it, particularly if you are in asset acquisition mode. So if you're putting together a portfolio, getting this positive cash flow is just so important early on, much more important for mortgage qualification processes than a quicker mortgage paydown period, because the banks want to see you generating income and positive cash flow from your properties so that you can continue to buy more. If you were to change your amortization length to say 15 years and you want to pay off your mortgages faster, well, now you're going to have much less cash flow. You're going to have to feed this property every month. And your annualized return stays about the same because you got more mortgage pay down on this, but now you have to come up with an extra $424 per month on this deal to keep it. And banks will look at this amount here and say, okay, well, you've got to feed this, and so this property would make it harder for you to qualify for your next investment property than it would if you stretch it all the way out or double that length to 30 years, and you're back up now to positive cash flow of $324 per month on your deal. So those are the numbers, and that's what affects principal paydown and sort of how principal paydown can change depending on how you structure your loan. I'm a big fan of variable rates of interest rather than fixed. I seem to always have done better with those. I'm not a mortgage broker though, so I'm not going to get into the variable versus fixed debates here. It seems like there's reasons for both every time you ask a good mortgage broker about that, but I've always gone with the variable for the most part, and I tend to stretch my amortizations out as far as I can. If I'm cash flowing really well, most of the lenders that you're working with will give you the option to pay up to 20% of your mortgage off every year. So if I've made good cash flow on a deal and I haven't spent it elsewhere, then you can always save that up and then at the end of the year make a larger lump sum payment. But if you select a lower amortization length at the very beginning, then you don't have a choice. That money is going to the bank and going to pay down your loan, and you will have less positive cash flow and less flexibility to do with that income, and less attractive positive cash flow for approvals on your next few properties. So that is principal paydown. I hope you guys have enjoyed the quick look at the numbers here. All right, so as you can see, there's an awful lot that goes into how to pick the right type of loan for an investment property. There's so many different variables that need to be figured out, but what you need to do and you need to keep in mind is that you've got professionals that can help you do this. Make sure you're working with an investment property mortgage broker and you're working with a realtor that really understands the local market and how to maximize the return on the actual piece of real estate that you're financing. If you can keep that in mind and keep your strategy in mind, it will make it much, much easier to choose the right type of mortgage for your next investment property. I hope you liked the video today. I hope you learned a lot. Thanks very much for watching, and happy investing.